Hello, this is Elaine Wu with the BERYL Consulting Group. Today we're joined by Gina Martin Adams, the former Chief Investment Strategist at Bloomberg Intelligence and now being the Chief Market Strategist at HB Wealth. Welcome, Gina. Thank you so much for having us.
Sure thing. Thank you so much for having me.
Given the current macro situation, a number of the strategists note a split between the economy and the market regarding the Middle East. Why hasn't this conflict derailed stock yet? And what would you say is the breaking point for the investors?
Okay, great question. I think it is definitely top of mind for most of the clients and prospects that we talk to at our
Mhm.
firm. It's very interesting because in some ways it did break the market. We did see a 10% correction in stocks from peak to trough. We saw some pretty severe disruptions in March, but we very rapidly erased those disruptions in the equity market while the economy is sort of muddling through. And I think that that creates a lot of confusion. But broadly, there are a couple of key differences between the markets and the economy that are important to keep in mind. The first is the market is 40% tech stocks. If you're following the S&P 500, 40% of the market cap of that index is tech and tech adjacent industries, which are experiencing an extraordinary recovery in earnings growth. In the first quarter, they're on track to post about 50% earnings growth relative to this time last year. So that's created a bit of optimism in the equity market that is really just has nothing to do with war in the Middle East and is really more about corporate earnings and this transition in AI that is underway as a tremendous driver of growth. On the other end of the spectrum, the economy has very little exposure to this in aggregate relative to the market. Tech and tech adjacent industries are only about 15% of economic growth. So I would say that's the biggest dispersion between the market and the economy is really it's about tech. And we are in the middle of an earnings season. The earnings season has been extraordinary for tech, and that's
Mhm.
getting reflected in stock market prices right now.
Great. And building on that broader macro backdrop, a lot of the cross-asset signals seem to be telling slightly different stories. The bond market is sending signals about inflation. Do these yields suggest a soft landing is actually happening, or is the bond market warning us of a looming spike?
The bond market has sort of mixed views on inflation. I
Hmm.
would say certainly at the onset of war, there was a little bit of panic, very evident in bond market prices related to near-term inflation. And we have, over the course of the last several weeks, taken out any expectation for Fed ease in the second half of 2026 in the bond market. As a matter of fact, we've been toying with the idea that the Fed may have to tighten policy because of inflationary pressures that are emerging. I think this is and is not impacting equity markets. It is to the degree that energy stocks are still our best performing sector so far this year. Energy
Hmm.
usually is the inflation hedge inside the equity market. To the degree that energy stocks are rising relatively quickly, it would suggest the equity market is at least paying some degree of attention to inflation. But broadly, equity market valuations are still really, really quite high relative to the long-term average, and that gives you a different perspective that would suggest equity markets are not at least worried about a disruptive inflation driven bond yield rise coming. And that could be the second half of this year, where if the bond market really starts to get nervous about inflation, that could suppress expectations inside the equity market. But for now, the bond market's sort of mixed views on inflation is enough for the equity market to overcome, given what they're seeing on the growth side. And I do think it's about growth and earnings growth. It really has powered the equity market, irrespective of what's happening with bond market inflation expectations.
A big part of how markets interpret those signals ultimately comes back to the policy. With
Yeah.
the new Fed chair likely to be confirmed next week, should we expect a steady as she goes approach or a major shift in the interest rate policy?
Yeah, I think this is really an interesting question. I can answer that through a number of angles. I would
Mhm.
say that at least at the start, it probably is somewhat steady as she goes. Mostly because it's going to be very difficult for the new Fed chair to create major waves in policymaking without gathering the consensus, if you will, of the 12 members of the FOMC voting committee. So that means that if there are big changes to policy coming, they probably roll out over an extended period of time rather than in the immediate term. That said, this incoming potential Fed chair, Kevin Warsh, has suggested that he would like to make some pretty significant changes to policymaking over the longer term. So while we may not see a lot in the short run, he does, for instance, prefer a very different communication mechanism than recent Fed chairs have sort of preferred. So we may see some changes in communication. We may lose the beloved dot plot, for example, which he's suggested is not particularly conducive to stability in financial markets and monetary policy making. So that's one potential change that could come sooner rather than later. He also has suggested that the Fed may need to lean on a slightly different measure of inflation for assessing inflationary conditions, towards something of a trimmed mean PCE as opposed to a headline PCE, for example. So that's another thing that we should be on the lookout for. And then probably the biggest potential game changer is Warsh has suggested that he would really like to wean the Fed off of and wean the financial markets off of a dependence on the balance sheet for policymaking, move more toward sort of a pre-GFC kind of Fed where interest rates were the predominant mechanism for monetary policy making in the United States. So that could be a pretty big game changer longer term. We know that the balance sheet has been a really big part of market language and market movements since the great financial crisis. By the time he makes this change, maybe 20 years of dealing with the balance sheet that we're trying to unwind. So we'll see how it goes. I expect little in the short run, but maybe some pretty big changes longer term.
Thank you. And bringing that back to the equities, it seems like markets are navigating both policy expectations and underlying fundamentals. Regarding the earnings season effect, is the market currently rewarding solid beats, or is it obsessing over cautious forward guidance?
Both. The issue is that we've had 80% of companies beating expectations. So on average, the companies that have beat expectations have only produced about 100 basis points of excess return on the day after their report. So you do have a modest reward, but there's 80% of companies that are beating expectations. So of course, in aggregate, that results in pretty strong price appreciation. For the companies that have missed expectations, and in particular are guiding a little bit lower, they have had a disproportionate negative response. So the day after their release, the net return relative to the S&P 500 has been negative 500 basis points. So really big punishment if you miss, in particular on top and bottom line. And if you start to guide lower, obviously a negative response generally in the market. It's just that those are few and far between. Most companies are beating expectations. We know that in the aggregate, the earnings season is turning out to be about doubly strong relative to analyst expectations at the beginning of the year. And that's helping stock prices float higher, even when you do have a few players in the market or companies that are struggling. That struggle is getting overwhelmed in the aggregate.
Right. And so taking all of that together, geopolitics, rates, and earnings, the big question for the investors is how to position. Based on these factors, are you telling the clients to get maybe defensive right now, or is there still enough momentum to stay aggressive in the equities?
I think that we're still in a bull market, even with the 10% correction that we had back in March. It's very clear that we're still in a bull trend, and generally we don't necessarily fight the crowd. But we are in a market in which large cap stocks, specifically large cap growth stocks, are commanding an extraordinary premium. So what I would say is we're constructive toward the equity market, but it's a nuanced approach where we're looking for ideas, looking for valuation opportunities, looking to ride the wave of the bull market still. Certainly wouldn't fight against that. But where we're getting overbought, maybe ahead of our skis and building in really, really strong expectations going forward, it's just going to be tougher and tougher for those companies to meet those expectations. We want to be careful with respect to that exposure. At the same time, take advantage of areas of the market that are still extremely cheap. One of those areas that we wrote about this week was emerging markets. Even though emerging markets have dramatically outperformed US stocks over the course of this year so far, and indeed are on the pace to do that for a second consecutive year, this is a group that actually got cheaper this year, even relative to large cap stocks in the US. Emerging market equities are trading at 12 times forward earnings expectations versus 21 times for the S&P 500. So there does appear to be a pretty big valuation discount there. There's also a relatively large valuation discount available in small cap stocks in the US, in value stocks in the US, in some of the cyclical relative to defensive shares. So there are a lot of opportunities still in equities. I just think you want to pick your spots relatively carefully, do the homework, and figure out how to ride the bull wave.
Thank you. And finally, as we think about the rest of the year beyond just the headline narratives, to wrap up, what is one under the radar metric that will define the rest of the year, regardless of what the Fed or earnings report would say?
Yeah, it's always tough to hang your hat on one thing. I will say we
Right.
definitely want to go across indicators and look at a sum of the parts approach when we're thinking about our
Hmm.
assessment of financial markets. One thing, though,
Hmm.
that we have been paying pretty close attention to is the ISM Manufacturing Survey. This survey is really interesting because it's historically very indicative of near-term movements in equity prices. Over the course of this year, it's produced now 4 consecutive months of appreciation or expansion indication for the US economy. This is something we have not seen since 2022. So to have this manufacturing survey coming out really bullish with respect to economic conditions that exist in the manufacturing survey is somewhat anomalous in the post-pandemic environment. It does suggest an underlying degree of economic growth that had not existed for the last 3 years in the manufacturing sector. It appears that almost all of this is still tech and tech related
Hmm.
industries that are driving that manufacturing renaissance, if you will. But we're watching this really closely because that has coincided with relative improvement in small cap stocks, some improvement in value stocks, some broadening in the broader equity markets. And I think it'll be consequential to sustaining those trends in the second half of the year.
Great. Thank you so much, Gina. A very insightful discussion on how geopolitics, policy, and market signals are shaping the path forward for investors. Thank you so much for sharing your perspective with us today. And thank you to everyone for tuning in to BERYL Elites.